A lot of people are trying to position ahead of this potential rate hike. It's obviously almost 100% odds there. We're looking at the CME Fed Watch tool in the upper 90s% of odds that we're going to see that hike. You're looking at the bond market right now, and you have a bit of a contrarian view. A lot of people are looking at short-term bonds, but you actually believe the 10-year is the place to be right now before that decision. Kind of explain why.
So we have a lot of uncertainty, and so we think that this is a great opportunity as we see a backup in yields to be adding longer-term bonds into your portfolio. Reason is it's going to be those longer-term bonds that really offset losses in your stocks if there's economic uncertainty and the economy slows down.
All right, so that's one thing that you're looking at. You're also looking at international investing. You gave me some things that you're looking at, specifically Europe. So when you look at Europe equities, they're actually outperforming U.S. equities in most ETFs. Why do you think that Europe has more room to run after already outperforming the U.S. so far this year?
One of the things that we've seen is that Europe is lagging about 6 to 9 months behind the U.S. in terms of the COVID recovery. And so when you combine that along with valuations that are 20 to 30% cheaper, we think you end up with a room to run here.
So one other thing we're looking at is the threat of a debt ceiling default. Obviously, the issues in the banking sector. In your mind, why isn't the Fed paying more attention to this? Why do we still believe there's just so much likelihood of that quarter-point hike?
Look, I think that there's a tremendous amount of uncertainty, but in the meantime, there's strength in the U.S. economy. And so the Fed wants the economy to slow down, and that's why they're going to be hiking here in the coming meeting. But that uncertainty can hit from out of the blue. I think the debt ceiling is definitely going to be kind of the next big test to the market. It's one of the reasons why you want to have your overall allocation back to your strategic allocation. And for most people, that means adding bonds back into your portfolio.
Okay, what about equities? As we look to a possible rate hike decision tomorrow, where are you putting money to work when it comes to equities as far as sectors and maybe even specific names if you have them?
Yeah, so I think you want to start with parts of the market that haven't seen kind of the strength of the rally that the S&P has. And I'd start with small and mid caps. They've really been lagging. They're priced for a decent discount, probably about a 20% discount to long-term averages versus the S&P 500. And then within that, one of the things we like doing is instead of trying to pick what the economy is going to do, go for secular growers. And so, one of the secular areas of growth has been security, whether it's in the real world or in the cyber world. Two of the names that we like there are Allegion, which focuses on in-world security, but automation of that security. So automatic bonds, automatic doors, automatic windows, and in the cyber world, we like CyberArk.